Have you ever wondered how a company like Apple or Google puts a value on something you can't even see? Like a brand name or a piece of software? Well, today, we're going to crack open the rulebook for these invisible giants of the modern economy. We're talking about IAS 38, the standard for intangible assets. So let's kick things off with a little puzzle for you. What does Google's search algorithm, the super secret formula for Coca-Cola, and a patent for a life-saving drug, what do they all have in common? I mean, they're all incredibly valuable, right? But you can't physically hold a single one of them. Exactly. They're all powerful but completely invisible assets. And that right there creates a massive headache for accountants. I mean, how on earth do you put a reliable price tag on something that doesn't physically exist? Well, the rulebook that tries to solve this very problem is International Accounting Standard 38, or IAS 38 for short. Okay, so let's dive into this world of intangibles. Before we can even begin to value something, we first have to agree on what it actually is. So what does the official rulebook say an intangible asset is? The official definition is surprisingly straightforward. The standard calls it an identifiable non-monetary asset without physical substance. Now, without physical substance is the easy part. It just means you can't touch it. But that word identifiable, that's the real key. It means you could, in theory, sell it or rent it out. It can't just be some vague idea like, our company's awesome reputation. And to make this a little more concrete, just look at some of these common examples. You've got things like computer software. Then there are legal protections like patents and copyrights that guard your brilliant ideas. You can even have things like customer lists, special rights like franchise agreements, or even import licenses. All these things give a company a real competitive edge. But here's the catch. Just having one of these things isn't enough to slap it on your balance sheet. For an intangible asset to be officially born, in accounting terms, it has to pass 3 really specific tests. Think of this slide right here as the asset's official birth certificate. To get recognized, it has to pass these 3 core tests. First up, identifiability. Can you separate it from the rest of the business? Second, control. Do you actually have the power to get the benefits from it and, crucially, stop others from doing the same? And third, future economic benefits. Is this thing actually going to make you money or save you money down the road? You need a solid yes to all 3. All right, so our asset is officially born. It's passed the tests. Now what? Well, it needs a price tag. The next step is figuring out its initial cost. And this is where there's a huge difference between buying an asset and creating one from scratch. And this is where it gets really, really interesting. See, if you buy a patent from another company, it's simple. The cost is whatever you paid for it. But what happens if you develop that patent yourself, internally? To deal with this, IAS 38 makes companies split that whole creation process into 2 very distinct phases. And this slide lays out that split perfectly. On the left, you've got the research phase. Think of this as the what-if stage, blue sky thinking, experimenting, trying to gain new knowledge. Because the outcome here is so uncertain, all research costs get written off as an expense immediately, period. But then, on the right, you have the development phase. This is where you take those research findings and start building something real. These costs, well, they can potentially become an asset on your books, or capitalized, but only if they pass another even stricter test. And this is that strict test. To turn your development spending into a real asset, you have to be able to prove all 6 of these things. Is it technically possible to finish? Do you actually intend to finish and use or sell it? Do you have the ability to do so? Can you show how it's going to make you money? Do you have the cash and the people to see it through? And can you reliably track every dollar spent on it? It is a very, very high bar to clear. But, and this is a huge but, there's a major exception here. Paragraph 63 of the standard is crystal clear. You can't capitalize the cost of creating your own brand, your own customer list, or anything similar. Now, why is that? Well, the standard basically says it's impossible to separate the cost of building your brand from the everyday cost of just running your business. So the asset made it. It's on the balance sheet. Is that the end of the story? Not even close. What happens next? How does a company keep track of its value over its entire lifespan? The company essentially has 2 paths it can go down. The first, and by far the most common, is the cost model. You just stick with the initial cost and then gradually reduce its value over time. The other option is the revaluation model, where you constantly adjust the asset's value to its current market price. but this is super rare for intangibles because you need an active market to get a reliable price. Think about something like taxi licenses. That just doesn't exist for most unique assets, like a one-of-a-kind patent. All right, we're almost there. The last big piece of the puzzle is figuring out the asset's lifespan. We have to decide how long we expect it to keep providing benefits. Does it have a finite life, or could it last forever, with an indefinite life? Now, to understand this next part, we need to get one key term straight: amortization. The official definition is the systematic allocation of the cost of an intangible asset over its useful life. But here's the easiest way to think about it. Amortization is to intangible assets what depreciation is to physical things, like a machine or a building. It's just spreading the cost out. And this is where it all comes together. If an asset has a finite life, like a patent that legally expires in 10 years, its cost is spread out or amortized over that 10-year period. But if it has an indefinite life, like a massive brand name you acquire in a takeover that could last forever, you do not amortize it. Instead, the company has to check it every single year for something called impairment, which is basically a fancy way of saying they test it to see if it has lost a significant chunk of its value. So why does any of this technical stuff matter? Well, because when you understand these rules, you get a powerful window into a company's strategy. Looking at its intangible assets and seeing how it treats its R&D spending, that tells you exactly how that company is trying to build value and invest in its own future. And that leaves us with a final big picture question to think about. In an economy that's shifting more and more from physical factories to digital ideas, are these rules, especially the one that forbids recognizing the value of a brand you built yourself, still the right approach? How will accounting have to change and adapt to truly capture where value is created in the 21st century?